All right, welcome back to the channel, everybody. Jason Brown here. Today, I'm welcoming a special guest, Mr. Brad Long, who is a personal financial coach known as the Zero Debt Coach. Now, Brad is on a mission to help 10,000 six and seven figure corporate employees and entrepreneurs organize their finances, obliterate their debt, and accelerate toward financial independence by starting and growing an online business. Now, today, Brad is joining us to talk about the topic of obliterating debt and reaching financial independence through investing. Now, Brad, thanks so much for joining us today and sharing your tips on this very important topic.
Oh man, it's my pleasure and honor to be here, Jason. I again appreciate you having me on, and I love talking about this stuff, and I know you do too. So it's going to be like a nice little sort of geek fest.
Yeah, that's awesome, man. And this is such a really good topic for me too, because I'm still kind of learning all this stuff, and there's so much information out there about investing. There's so many different types of investments, and if you get on the internet, it's just going to be information overload, and that's why I wanted to talk to you about this. Someone who is an expert in the field, who has done this in your life, and who coaches others on how to invest. So this is going to be really good, not only for me, but hopefully for anybody who watches this who might be interested in learning about different types of specific investments. So let's dive right into it. First question, Brad, kind of alluded to it just a second ago, but where should someone who has no knowledge of investing start? How do we get started in investing?
Great question. I want to backtrack for a second and say that as I think anyone who would be given the moniker of investment expert, I shudder at the at that notion, because I think that we're always a student. We get to that higher plane by studying and by just ingesting and really getting into investments ourselves. I think the greatest place to start is actually before you actually start investing, is to make sure that you're in a posture where you should be investing. So, with a lot of my students, they come to me where they have a lot of consumer debt, they have a lot, high levels of debt, and we'll actually tell them or advise them or suggest to them that they should stop investing while they're paying off their student loans, consumer debt, car payment. Now that can be kind of controversial with some people, because they've been fed this. There are certain sort of mantras in our culture that, you need to be investing and you need, and so what we try to do in our process, and I'm sure you do this as well, is like, we just need to kind of step back and take a look at the overall picture and figure out where you are in that. So if we've addressed that, and you've got, your consumer debt is addressed, you've got, a healthy emergency fund of reserves of, I would typically suggest 6 months to a year's worth of expenses. Then I think somewhere along that continuum, you're ready to start investing. So the very first step that I would say is kind of look at what you're interested in. It could be stocks, bonds, mutual funds, ETFs, index funds, more of the traditional type of stuff. Are you interested in real estate? Are you interested in cryptocurrency, or some sort of mixture of those? And you really start to lean into those and try to understand them. I know that one of the things that Dave Ramsey teaches that I really like is he talks about, you really should never put your money in any kind of investment unless you can sort of explain it to a 5-year-old. And so that really is the education piece of that is going to be super important. Like, can you explain what a stock is? Can you explain what a bond is? Do you know what an ETF or a mutual fund or an index fund is? Can you explain that to your kids or to a 5-year-old? So that's important. I think the very next step, same thing with cryptocurrencies. Do you understand blockchain? Do you understand Bitcoin, Ethereum, smart contracts? Start to, and a great resource to do that is to go to investopedia.com and start to get some of those definitions down. And then once you've sort of, landed on where it is that you want to start putting your money, I think it's important to, there's a tendency for people to want to go all in. I want to go all in. I want to put, all of my investments in this one thing or this one group of things. I would recommend that you sort of dip your toes first. One of the things a lot of our students want to get into cryptocurrencies, and one of the first things that I tell them to do is go open a Coinbase account and buy $10 worth of Bitcoin. First of all, it's going to walk you through the process, and this could be the same thing with, you know, an ETF or a mutual fund. You know, go open a Vanguard account and go through that process of opening the account, funding the account, and then buying whatever the asset is, so that you understand how things move and you understand how transactions occur and you understand the difference between what a bucket is, you know, an IRA or a 401k or a Roth IRA. You know, you understand what the bucket is as opposed to what the investment or what the asset is. And so there's this progressive sort of education that you have to really understand in order to know what you're doing. So that's usually where I start with students.
That's a tremendous overview, Brad. And I think you answered all my questions in that one. But we're going to actually dive into each thing a little more specifically. And
yeah, absolutely. There's plenty of room to go down rabbit trails on all those things.
Right. We're going to break down some of this stuff. But that was a really good overview of all the different types of investments that are out there. And there's so much out there that you could invest in. So there's so much, like you said, there's so much to learn and research. So let's just talk first about traditional investing. So traditional investing, the first thing I think of is just individual stocks. There's also, you hear a lot about index funds, and I'm going to let you can share more. But why don't you talk a little bit about just individual stocks, pros and cons, and then explain what an index fund is, and is that something worth investing in as well? And tell us about ETFs. Is an ETF also a traditional?
It's an exchange. It stands for exchange traded fund, and it's very similar to a mutual fund or an index fund. So I think that, you know, the individual instruments really depend on, again, your level of interest, you know, what you lean toward. If you're going to put your money into something, you know, like say, for example, you want to buy Walmart stock or Amazon stock, and I'm not a financial advisor, so I'm not giving financial advice. I'm not necessarily recommend that you get into individual stocks. Actually, I usually advise my students away from individual stocks because there's much more risk involved in those. But that said, if your risk profile is such that you want to put part of your portfolio into stocks, I mean, essentially a stock is you're just buying little bits of ownership of a company. So if you buy a share of Amazon stock, that means that you're part owner of Amazon. And so you have, I guess, if you have a certain number of shares of a stock, that gives you voting rights on, you know, leadership and, you know, certain things that they take votes on from the shareholders. So there are individual stocks. Bonds are basically debt instruments that, you know, different corporations or different organizations issue to bondholders. So you're basically giving them a loan, and then they're basically telling you like, hey, this is a 10-year note, so we're going to give you a certain percentage rate over the course of this time. A mutual fund, an ETF, or an index fund are all, you know, basically pieces of a lot of different companies that are sort of amalgamated under one, you know, umbrella. And so I think for the purposes of this, you know, of this discussion, that's a good place to sort of just couch it in general terms, is that you're sort of spreading out the risk into a basket of whatever that index fund is, for example. So one of the more popular index funds in the financial independence community is Vanguard's Total Stock Market Index Fund. And so that's basically when you buy shares of VTSAX, which is what the ticker symbol is for that, you're buying a piece of the entire S&P 5. I think it's the S&P 500 or total stock. It's either the S&P 500. I haven't really been in that one for a long time, so I can't remember. But I think it is the S&P 500 that you're buying a piece of that. So those are all, you know, sort of traditional investments, and then you're putting those, again, you know, going back to the analogy that I was talking about a minute ago. You're putting those into different buckets. So if you have a corporate job or you know, some sort of company that you work for, you can put that into a 401k, which is a tax deferred bucket. If you want to put it into a Roth IRA, that's an after-tax deferred bucket. You could have a regular taxable brokerage account, which is where you can take your after-tax money and sort of use that as a savings/investment account. And then as you take profits, and cash out of certain, assets that you're putting in there, you have to pay taxes on that. So that's a really, really 30,000-foot overview of sort of traditional market investing.
Gotcha. Now, when you were talking about all that, I was just thinking of my company that I work for is an employee owned company. So they
Mm.
actually offer you the opportunity to purchase company stock as a, it's called an ESOP, which stands
Oh
for
yeah. Hmm.
employee, ESOP, employee stock ownership plan. I knew I was going to get that. So
Right.
ESOP.
Yeah.
So Brad, what do you think about ESOPs, and is that something that is worth investing in?
Yeah, I think that it really depends on, investing is such an individual endeavor. And so it really depends on so many factors. Where are you in your risk profile? What is your company like? How do they sit in the marketplace in terms of their value to the marketplace, in terms of their future value to the marketplace? There are just a lot of factors that you have to study. How comfortable are you putting a certain percentage of your assets into that? I've, in my past in, corporate life, the companies that I work for, I was actually never huge fans of. So I didn't really put much stock in an ESOP plan, just because I didn't really plan on being in those organizations for an extended period of time, and I didn't really see the value of that. I felt like the level of involvement and engagement in the management of my own portfolio, I was able to get better returns by managing my own, assets in other assets, for lack of a better term.
Yes, I understand. So to circle back on the individual stocks versus like an index fund. So you're thinking an index fund might be a more better investment versus an individual stock because it has kind of the umbrella of all of the other stocks kind of rolled into it. Is that kind of the idea?
Yeah, that's the idea. I mean, you're really diversifying risk. I think another huge thing in the environment that we're in now, here we are, November of 2021, is inflation. And so any dollar denominated assets, you really have to factor in, inflation as well. So one of the things that, my wife and I do, and we, teach our students to do, is diversify out of dollar denominated or fiat denominated assets. And, we're big fans of precious metals, not necessarily as an investment, but really as an insurance policy against inflation and against, central bank money printing, which we're seeing a ton of that right now. And then also cryptocurrency investing, which I know is still a little bit wild, wild west. And it's something that a lot of people still cringe over, but it's a very legitimate asset class, especially when you look at maybe the top 10 valuations market cap wise in the cryptocurrency space: Bitcoin, Ethereum, XRP, a lot of those projects per se.
Okay, those were tremendous transitions, because those are the next two things I wanted to talk about, was crypto and then the precious metal. So let's talk about crypto first. Brad, I'll be honest, the crypto craze has been very fascinating for me to watch and to follow through the media. And I will be completely transparent. I do not understand any of it. It doesn't make any sense to me. It's hard for me to comprehend. But apparently a lot of people are investing in this and making a lot of money in this
Mm-hmm.
space. So what can you dumb it down for me, Brad? Help me
Yeah.
understand. Is this worth, investing in?
Yeah. The answer is it really depends. I think a great place to start in your understanding of Bitcoin, which is sort of the original and I believe most valuable cryptocurrency and blockchain, is to really, and it takes, I will be honest with you, I've been in the space since about 2010, 2011. I became an investor somewhere, I think in 2014, but I've studied the space for, basically a decade at this point. I think a great place to start, and I really think that it takes about 100 hours over the course of an extended period of time to really kind of get an understanding of the actual value of Bitcoin and cryptocurrencies. And then you have to look at each individual project and the need that it's sort of addressing, or the potential need that it's addressing in the marketplace. So I definitely am one of those people that will advise my students to be like, you need to really understand it. And then once you have some sort of modicum of understanding of it, then you go, open a Coinbase account because that's the easiest place and probably the most secure place to exchange fiat currency for cryptocurrency. And then, just do, a $10 transaction, kind of like what I was saying earlier. You want to do a very small, transaction so that you can understand how to open an account, how to fund an account, connect your bank account to it, how to purchase the asset, how to move that around to different types of wallets, and we're getting into terminology that you can very quickly go down a rabbit hole for somebody that's uninitiated. But I think a great place to start in your understanding of cryptocurrency is to go download for free the Satoshi white paper. So the Satoshi white paper is basically the foundational white paper and the reason, the why behind why Bitcoin was created. And it was created as a direct deflationary asset. There are only 21 million that will ever exist. It was created as a direct sort of response to what the central banks are doing. So what these central banks, like the Federal Reserve, for example, is they're inflating their currencies. So they just continue to print money. And so if you think about that, as you create more of something, each unit of that becomes less valuable. And so when you compare that to a fixed, and arguably gold and silver are relatively fixed in terms of what can be mined every year, a deflationary or hard cryptocurrency asset like Bitcoin, where there will only be 21 million ever in existence, it's sort of a hedge against that inflation. And that's part of the reason, and this is getting into macroeconomics, which is a subject that I love. You're getting into how, a cryptocurrency, particularly like Bitcoin, addresses the energy that's being created by the central bank money printing, and it's all being absorbed into that. So the price rising that you're seeing in the cryptocurrency space is a lot of that inflationary pressure, that inflationary energy that's going into those markets. So there's a huge subject, and we could talk for hours about it, but that's, I think, going and downloading the Satoshi white paper and really reading through that and really understanding the why behind why it was created, and then also the blockchain technology and how transactions work and that sort of thing is a really, really great primer. And I think could very easily take up your first few hours of your first 100 hours of studying to be a cryptocurrency investor.
Very, very fascinating. And I'll try to get that white paper you were mentioning. I'll try to link that up in the description below for everybody to read that. I would actually like to read it myself. It sounds great.
I highly, highly recommend it. I think it's a great starting place because there's a lot of hype out there, and there's a lot of, go buy this, go buy Dogecoin, boy. It's like, well, no, wait. You gotta really have an understanding of what you're getting yourself into. So that's a great place to start.
And Brad, I didn't realize that crypto had been around that long. It sounds like over 10 years, you're saying it's been around?
Yeah. The first, they call it the Gemini block of Bitcoin, if I'm not mistaken, was mined in 2009, actually. Yeah.
Oh, wow. Yeah. I had no idea.
So, when I got into my first go around into Bitcoin, when I first got into it, Coinbase actually started back in 2012. Coinbase has been around since then. And then when I first got into Bitcoin, it was like right around or under $100 a coin. And now, today we're looking at over $60,000 per coin.
Oh, wow.
So, that speaks to, again, that inflationary energy that's going into those markets.
Very, very fascinating to watch for sure, is this crypto craze, as I call it.
Yeah.
All right, Brad. So let's talk about, you talked about it a little bit, the precious metals. So precious metal investing has been around. When I think of precious metals, I think of my grandparents, because that's what they always talk about. The people of my grandparents' age, you got to have your gold and your silver, the other precious metals, and they will invest in that and save it. And they'll talk about how the price of gold has gone up, X amount of percent over the last, several years. And they'll explain to you how that's such a better investment than anything else that you're going to invest in. So talk to us a little bit about, precious metals, gold and silver. Are those still good investments compared to the other stuff we've talked about?
Yeah, man, that's a great question. And I think that the background that I will sort of give you goes back to the 2007-2008 financial crash. And that was really what I like to call my second financial awakening. My first being, in 2004 when I woke up $174,000 in debt and, went through the debt elimination process. That was my first financial awakening. My second financial awakening was the 2007-2008 crisis, and I was probably one of the few people that watched some of those C-SPAN hearings where they were doing the TARP bailouts, of the banks that had the banks and insurance companies that had actually had a hand in causing the crisis. They were bailing them out, and then they were writing checks to bail out the car companies as well. And I was like, wait a minute, that was really the first sort of awakening that I had as to, okay, what is money? And we're kind of tiptoeing into the realm of macroeconomics. And I think it's a really important mantle to kind of put on and start to understand if you're really going to be an investor, because one of the things that you're fighting against, especially in this environment, is inflation. So, when you start going down that rabbit hole, you understand that in 1971, Richard Nixon took us off the gold standard, which the gold standard basically meant that we used to, every single piece of U.S. currency, every dollar used to be backed by a physical piece of gold. And so in 1971, Nixon took us off the gold standard, which basically they call that closing the gold window, where now the dollar was not redeemable for gold. And so it became this floating fiat currency. And so now where we used to be pegged to gold, which was a finite asset, and again, I kind of allude to Bitcoin, and what I've talked about previously. And so now we're on this floating standard where the US dollar is basically a debt instrument and all other world fiat currencies are pegged to the US dollar. So all of that to say that when you look at gold and silver, you look at precious metals, again, I don't really look at it as an investment. I look at it as a hedge against inflation and what I like to call central bank insurance. Now, I will say that as I've gotten into more deeply, and I've been a precious metal investor for over 10 years, there's a lot of manipulation that goes on in those markets. So I recommend, and for us, to hold physical gold and silver rather than a gold and silver ETF or exchange traded fund where you actually don't own gold and silver, you own a contract against gold and silver. And that's a whole other rabbit trail that we could go down maybe in a future conversation. But suffice it to say that, I think it's a decent investment, but again, I don't look at that as an investment. I look at that as central bank insurance. And if there is ever sort of a great reset or a great financial crash, I want to have a certain amount of my assets allocated in hard money like gold and silver. So I feel like we're pretty well diversified in traditional, assets, stocks, bonds, mutual funds, ETFs, index funds, things like that. Gold and silver as part of an insurance policy, and then, some very select cryptocurrencies also as insurance, but also as being in a position to take advantage of this incredible inflationary energy that we're going to continue to see over the coming years. So I know that's a lot, but it's a deep rabbit trail for sure.
Yeah, there's so much to learn with all these different types of investment options. Now, Brad, just hearing you talk, I'm hearing the overarching theme is diversify, and that's what you always hear from all the financial experts is you have to have a diversified portfolio, diversify, and that it's kind of, I think that's what I'm hearing from you. Is that right? Would that be kind of your ultimate advice here, is just make sure that you diversify?
Yeah, I think that's just I think that there's a lot of financial speak and there's a lot of buzzwords that people like to throw around. And so this is, going to speak to the point. I don't know if you're going to ask me about this or not, but I don't like or recommend traditional financial advisors. I'm very leery of the traditional financial system because I think a lot of people, and I think this kind of speaks to your question, they hear these phraseologies from financial experts, maybe their financial advisor, maybe some talking head on CNBC, and they're like, yeah, I need to diversify. Well, first of all, you have to ask, what does that even mean?
Right.
And so diversification is really going to be different for every individual. So do I think diversification is a good idea? Absolutely. But what does that look like in your specific situation? Where are you, along the continuum of eliminating all of your consumer debt, getting that 6 months to a year of emergency fund, and then getting yourself into a posture potentially to pursue financial independence. What's your age? What's your risk tolerance? Those are all things that really require an education process. And we teach our students that you should never put that in someone else's hands. As a financial coach, I've interviewed a lot of different financial advisors that have courted me to be maybe one of their clients or to come to work for them. And I just don't like the compensation model, especially in terms of them being paid a percentage of my portfolio for managing my assets. I'm of the extreme passionate point of view that you can learn, not only can you learn this stuff and do it for yourself, but you really owe it to yourself to do it for yourself, because there is no one on the planet that is going to manage your assets like you are, because you have skin in the game, not somebody else.
Excellent. You answered a question that I wasn't going to ask in this interview, but actually is a question that I always ask myself is, do I need a financial advisor? Do I need to hire a financial planner? And again, this is one of those that you ask 10 people and you'll get 5 on one side and 5 on the other side. So that's good. That's really good. The way that you articulated that was really very thoughtful.
Well, and if I could, I'd love to, expand on that. I'm not going to say that it's never a good idea to have a financial advisor. I think that you can get to a certain level of assets that it's almost required for you to have somebody in your corner that you compensate in some way, shape, or form to help you move things, to help you manage things. What I advocate, so I'm not necessarily saying you should never have a financial advisor. What I'm saying is that you should never turn over the decision-making or the recommendations of your financial life to another human being. That should always be in your purview and your control, and you should never say yes or no to anything unless and until you actually understand it. So I think that's maybe just a little bit more of a clarifying, yes, point of view.
That makes perfect sense. And
and part of the reason for that is, like you probably see, in your interaction with, students or clients or people that you're trying to help through the debt elimination process, sometimes people are just really lazy with their money. And whether they have like a little bit of it or a lot of it, they would rather just hand over that responsibility to someone else. There's not a lot that guys like us can do, to kind of, wave the flag and say, you shouldn't do that, because some people are just going to do that anyway. But the people that we can kind of bend their ear and encourage them in the direction of financial acumen, I'm raising the flag to say, no, you should never do that. You have to become a student of your own money. I mean, you've traded in many cases so much of your time, your blood, your sweat, and your tears for those units of currency. So you should be the one that has the final say in what's being done with those. And some people are going to listen and some people aren't. We're here to talk to the people that will listen to that.
That's a perfect way to end this conversation right there, Brad. So I want to thank you so much this has been a tremendous overview of just investing in general, just different types of options to invest in. And just hopefully people will learn something from this conversation and kind of maybe give them a direction in which they might want to go. But before we say goodbye, Brad, I want you to let everybody know how they can connect with you. If someone wants to reach out to you for your coaching services or wants to, check out I know you have a YouTube channel with a lot of videos there, website, anything you want to promote, just go ahead and let people know the best way they can get in touch with you.
Well, thank you so much, Jason. I really appreciate you having me come on, and it's always a pleasure to have these conversations. My website is www.zero-debtcoach.com. My YouTube channel is Bradlong-ZeroDebtCoach, all one word. And that's really where I put out the majority of my publicly free facing content. I will say that, this coming week, we're releasing a brand new budgeting course, and we're doing a free workshop on next Tuesday, the 23rd of November at 7 p.m. So if you're interested in that, if you're trying to learn how to budget, that's a precursor to all this investing stuff. So that's something that we're happy to come alongside and help people nail that fundamental skill before they start investing or even while they're investing, because it's important, right?
That's awesome, man. I appreciate all that you do to helping people with their personal finances, Brad. So as we wrap up, I just want to say thanks again to Brad Long for joining us today and sharing some of his knowledge and tips on the wide world of money financing, personal financing, and investments. And until next time, this is Jason Brown saying thanks so much for watching. And to never forget, it's not the amount of money you make, but the margin that matters the most. See you next time.